The broadcast is now starting. All attendees are in listen-only mode.
Okay, we were apparently on mute, but wanted to say hello and welcome everybody to the webinar today. This is Nathan Lee with Richey May. Hope you are all doing well this time of year. I'd like to thank each one of you for joining with us today. I hope you'll find the presentations that we're going to share beneficial to you and your companies. A couple housekeeping items to get out of the way as we start. If you have questions, submit them online through the chat function, and we'll get to as many of those as we can, time permitting, at the end of the webinar. And also, just wanted to mention the slides as we go through them. They are full of a lot of text. These are technical topics that we'll be presenting on today. So the slides are kind of busy, but that's intentional because we want to send these slides out to you afterwards, and we hope that by having as much information as possible on there that it's helpful to you as you review them at a later date and incorporate them internally. And with that, I want to just introduce the presenters today. We'll first be hearing from Jennifer Hanna, who is one of our senior audit managers at the firm, and she is going to share with us some recent kind of accounting and audit-related updates specific to the mortgage industry. And then following Jennifer's presentation, Nancy Stevens, who is one of our tax managers, will do the same on the tax side and present some topics that are relevant, kind of up-to-date current issues on the tax side that we're seeing and dealing with a number of companies in the industry. So with that, thanks again for joining us, and submit questions as you have them, and I'll turn the time over to Jennifer.
Hello. All right, so we are going to go through, as Nathan said, some recent accounting updates. Just a couple things we're going to go through. We tried to pick things that were, specific to the industry that would have kind of more of an impact on you guys, such as revenue recognition, Ginnie Mae pool delinquencies, going concern, just a variety of things like that. And as Nathan said, feel free to do the iChat and send over any questions, and if we don't have an answer or we can't get to it, we'll definitely get back to you with any questions that you have. So the first thing we're going to talk about is revenue recognition. And we have some time on this one. It doesn't take effect until December 15, 2017. And it shouldn't have that big of an impact on our mortgage banking clients. Potentially when you're selling a real estate portfolio, it may. We should have some, you'll have more liberal stance of when you can recognize revenue. Types of companies that will be affected by this are going to be like software, construction, that type of thing. The revenue recognition for customer contracts, it's basically a 5-step process you go through: identifying contracts with customers, identifying separate performance obligations in those contracts, transaction prices, how you allocate those transaction prices to your performance obligations, and basically recognizing revenue when you've met those performance obligations. The next thing is the Ginnie Mae pool delinquencies. And this one is definitely open for discussion. The MBA is currently researching this and getting opinions from a variety of accounting firms to see how they're treating it. Most of the Big Four and the national firms choose to present it how we're going to discuss it in the slide, but this is something that is open for discussion at this point in time. It's basically the Ginnie Mae program gives the transfer a unilateral right to purchase delinquent loans out of the Ginnie Mae pool that are greater than 90 days delinquent. Because you have that control over that asset, even though you don't have the intent to purchase those loans out of the pool, it gives you the power or the control over those specific assets. So most of the larger firms and the Big Four are recording the corresponding asset and liability on their balance sheet related to those delinquent loans and then having a footnote disclosure on it. But again, that's something that's definitely being discussed right now by the MBA. The next will be consumer mortgage loan foreclosure. And this is basically just how you present on your balance sheet and the required disclosures related to foreclosed loans and collateral on those loans. So for our purposes, it's basically moving your VA or FHA mortgages purchased out of your servicing portfolio that are being foreclosed on into other receivables. And you're going to record those mortgages at what you expect to receive on the loan as opposed to what you feel the fair value of the loan is on those particular types of mortgages. The next thing is discontinued operations. And this is 2014, but this is going to significantly reduce the number of dispositions resulting in discontinued operations and define it more stringently. And when we mean defining it more stringently, it's basically discontinued operations are now going to represent a major strategic shift of the entity's operations and financial results, and that's how you're going to record it in discontinued operations. These major shifts are going to include things that are not limited to things like major geographic areas, major lines of business, major equity method investments, or other major parts of the entity. It eliminates the requirement to evaluate continuing involvement with the disposed component to conclude on how you presented it as a discontinued operation, but it also expands the disclosures about your continuing involvement with the discontinued operations. It's basically a lot of changes to the disclosures and kind of who qualifies as a discontinued operation. Going concern, this is going to take effect December 15, 2016. In the past, it was kind of up to the accounting firms to determine if a company was subject to a going concern. Now this kind of pulls this out of the accounting firm's hands and puts this as a responsibility for the company. So now the company at each interim and annual reporting period is going to have to assess if they have a potential going concern issue. The going concern assessment is going to be based on relevant conditions or known events or reasonably known at the assessment date. And then any substantial doubt would incorporate a likelihood component using the term probable, which should be familiar when dealing with contingency losses. Lease accounting. This one has been out there for a while now. It's still in the exposure draft phase, but it's expected to eventually finalize. It basically requires lessees and lessors to apply a right-of-use model to account for leases. Leases generally would be on the balance sheet for lessees. These leases you would basically book an asset or liability, and it would be measured at the discounted present value of the fixed lease payments over the estimated lease terms. There's a variety of lease classification tests based on the nature of the underlying asset and type of lease that you have, the extent the economic benefits are consumed by the leasee, and just the pattern of income expense over the lease terms. In general, rule of thumb, land or buildings will generally be on the straight line method, where other property will generally have an accelerated method of recognizing income and expense. The next thing is going to be share-based payments, which is going to go into effect in December 2015. Accounting for share-based payments is basically when the terms of the award provide that a performance target could be received or be achieved after the requisite service period. It requires that a performance target that affects vesting and that could be achieved after the service period be treated as a performance condition rather than being reflected in estimating the grant date fair value of the reward. So this is basically saying if you have a performance target that could be achieved after that requisite servicing period, it's not going to be used in estimating the grant date fair value of the award. And the compensation costs associated with the award will be recorded in the period in which it becomes probable that that performance target will be received or achieved. So the financial instruments project, this project has been backed off of, and there's not a lot going on with it right now, but we wanted to throw it out there and mention it to you guys. It's basically looking at the fair value option and assessing fair value on mortgage loans held for sale. The project is expected to reconsider the recognition and measurement of financial instruments, but it has been backed off on, but we just wanted to throw it out there and let you know that it is something that it has been discussed. The next slide we're going to talk about is the credit risk model. This too is in the very early stages, and it's basically going to potentially affect your loan loss reserve. An entity should apply the current expected credit losses model to all financial assets measured at amortized cost. The model would use a discounted cash flow method. That's the preferred method, but there are other methodologies that you can use in determining this credit risk model. Some of the factors that you would consider when using this model are relevant information in assessing the collectibility of contractual cash flows, including information of past events, current conditions, and reasonable and supportable forecasts when developing an expected, credit loss estimate. You're also going to consider relevant qualitative and quantitative factors that relate to both environment in which the entity operates and also the borrower's environment is also going to have an impact on how you assess this model. And of course, things like prepayment speeds. These are just a couple things that kind of go into this model. But let's say you sell a loan servicing release and you don't have access to this information. An entity can revert to an unadjusted historical credit loss experience for future periods, so you can rely on historical information if you don't have access to current information on this particular loan. Goodwill. So this is going to take effect pretty shortly, December 15, 2014. It's basically only applicable to private companies, and it is an accounting election or accounting alternative. So it's basically you can elect to amortize goodwill over 10 years, or if you consider the useful life to be lesser, you can also choose to amortize it over a lesser useful life if you can demonstrate that it does have a shorter useful life. And you can also, now you're just going to test for impairment when there is a triggering event. So this could have a pretty significant impact if, people decide to start amortizing their goodwill on their balance sheet. And the last slide we're going to go over is the consolidation VIE leasing arrangements, and this too is taking effect pretty shortly, 2014. It's specifically related again to private companies, and they can elect not to apply VIE guidance for assessing whether or not to consolidate a lessor, which is under common control. So in the past, if you had a lessor and it was, a common control with your specific entity that fell under the VIE rules, you would have to consolidate that entity into your books. This is basically saying, the guidance that I read is, you don't get a lot of benefit of consolidating that entity into your financial statements. So you now have the option, if you are a private company, to not consolidate that lessor entity into your books if the majority of the activity is related to leasing activity. This would be an accounting alternate too. When you elect it, you'd have to apply it to all future lessor arrangements held under common control. And that's basically it for the new accounting updates. If you guys have any questions, feel free to reach out. My email address, my phone number is on the slide. I'd be happy to answer any questions that you guys have. And so right now we're going to switch to Nancy, who's going to go over recent tax updates.
Hi, I'm Nancy Stevens, and I'm just going to talk about a few things we've seen. We called it various hot topics in tax. Just a moment. So some of the things that we have seen companies doing, 13 and 14, is they've been having MSR bulk sales. So we'll be going over some of the tax implications related to that. We've also seen companies doing foreign travel conventions outside of North America. And we just wanted to make you aware of some of the implications related to doing a seminar outside of North America, as well as we'll be discussing a deferred compensation. We'll be touching base on that. So regarding the MSR sale, the tax treatment is a very complicated topic, and it should be discussed with your tax advisor prior to the sale in order to maximize your potential tax savings. There is a potential of allocating the sales price between capital gain and ordinary income. As you're aware, MSR sales, for GAAP purposes, you would have a basis, but for tax purposes, you don't have a basis. So the total proceeds of the sale is going to be taxable. That's why it's beneficial. So if you sold your MSR portfolio for $3 million, that's all going to be taxable. So if you're a flow-through entity, it could be significant tax savings to be able to identify what portion is ordinary versus which portion is capital. Keep in mind, if you're a C Corp, it needs to be determined if there's a benefit of segregating between ordinary versus capital gain, because if you're a C Corp, it's all taxed at the same rate. The only time it may be beneficial is if you had capital losses. In that instance, your MSR sale, you'd be able to utilize those capital losses if you take capital gain treatment on the MSR sale. So because this is a pretty hot topic, the MSR sale transactions have predominantly been determined in the Fifth Circuit Court of Appeals with very limited recent guidance provided by the IRS. Based on the decisions of the Fifth Circuit Court and related IRS guidance, MSRs have at least one and up to three components, including the following: normal servicing, which is typically ordinary income. We have the excess servicing component, which is likely capital gain, and goodwill, which is capital gain treatment. The receipt of proceeds from the sale or other transfers of MSR that represent a substitute of future monthly normal servicing fees, i.e. compensatory portion, is clearly considered by the courts to be ordinary trade or business income and is taxed at the ordinary income tax rate. The compensatory portion of the MSR represents the present value of the reasonable compensation that the servicer is expected to receive over the life of the contract, less the present value of expenses of providing the services. The difficulty is that there are no recent IRS or regulatory guidance or set of assumptions that clearly specify what is considered reasonable compensation under the current market conditions. As such, taxpayers must build their own valuation models based on reasonable assumptions to determine that the presence of these three components of the MSR being sold. So because there's not reasonable assumptions, what we typically do is Richey May will typically work with your valuation company so we can determine a great method to evaluate your MSR. And typically what you'll provide to your evaluation company is the details of your MSR portfolio that was sold so they can identify what portion is long-term, what portion is short-term. You'll also provide the discount rate for evaluating your normal servicing, the discount rate for evaluating the goodwill portion, and also provide the gross profit margin and basis points of what is deemed to be reasonable for the rate of return for servicing the mortgage loan. This should all be documented on how these assumptions were determined. Once those assumptions are determined, the valuation company will take that, run the data, and what they will come up with the economic value. So once they come up with the economic value, we at Richey May will compare that to what the market value, the proceeds received from the MSR, less the economic value, and that will be what we determine as what portion of it's going to be capital gain versus ordinary income. Keep in mind, if your portfolio is less than a year, then that portion is going to be short-term capital gain. If your portfolio is longer than a year, then that's going to be you're going to have capital gain treatment on that. So as part of your portfolio, you may have excess servicing, which is the portion of the selling price that represents payments in excess servicing would likely be taxed at your capital gains rate, long-term or short-term, depending on whether the holding period exceeds 1 year. Keep in mind that the safe harbor for excess servicing is 25 basis points for conventional loans, 45 basis points for government loans, and then 37.5 basis points if they're adjusted rate mortgages. After the selling price of the MSR portfolio has been first allocated to your normal and excess serving components, any remaining selling proceeds represents payment for goodwill, and the capital gain is taxed at the lower capital gain rate. Keep in mind, long-term capital gains are at the favorable capital gain rate right now at 20%, and then short-term capital gain rates for individuals are typically taxed at the ordinary tax rate. So capital gains, short-term capital gains may offset capital losses, but there's no favorable rate. So if you do have an MSR sale, please reach out to us because the process of working with the valuation firm, seeing the tax benefits is really beneficial for the company. So we are here, and if you need advice, we would like to be involved in that as well. The second topic that we're just going to touch base on is conventions outside of North America. So we have been seeing companies take loan officers to conventions outside of North America, and we just want to make sure you're aware of the tax implications of doing that. So under Internal Revenue Code 274H, generally an individual who attends a convention or seminars or similar meeting which is held outside of North America, no deduction will be allowed under Section 162 for expenses unless the taxpayer establishes that the meeting is directly related to the active conduct of his trade and business. Keep in mind that, for example, typically companies that do national business and have business in other countries like China and so forth, I mean, maybe meeting in London makes sense for that company. As a mortgage company, it's going to be harder to argue because if you're not conducting business in a foreign country, then the IRS is going to look at why do you need to have a convention held outside of North America. So the employer, therefore, must establish that there is it's reasonable for the meeting to be held outside of North America instead of inside of North America. And the test they use is the reasonable test factors, which is your purpose and activity of the meeting, the sponsoring organization, the residence of the organization's active member, and the location of other meetings. Keep in mind the time spent in business meetings or activities must be substantial when compared to time spent sightseeing and engaged in other personal activities. Otherwise, the travel is going to be deemed personal vacation, and only meeting registration fees or other directly related business expenses will be deductible. This rule also applies to conventions held into North America as well. So the IRS defines North America to mean the U.S., its possessions, i.e. Puerto Rico, the U.S. Virgin Islands, etc., the trust territories of the Pacific Islands, Canada, and Mexico. And I listed a rev ruling there for you to look at the definition. Keep in mind that certain Caribbean countries in North America under the beneficiary county rules qualify, i.e. Bahamas, Costa Rica, the Dominican Republic. They qualify because there's a tax treaty with the U.S., so that's how those qualify. But keep in mind, if you are holding conventions outside of North America, please consult with us to make sure your destination qualifies and make sure you can substantiate why you want to hold that convention outside of North America. Just a moment. I need to go back one slide. Okay. So now I'm going to touch base on deferred compensation. We just want to make you guys aware of the deferred compensations and the implication of 409 Cap A. So deferred compensation is any compensation payable after the employee has legally binding right to it. Non-qualified deferred compensation plan is any plan that provides the deferral of compensation except, you know, your qualified employer plan, which is your retirement plans, your vacation leave, your sick leave, your compensatory time, disability or death benefits, your MSA, your HSA, your health and medical reimbursements, accident and health plans, and others. Some examples of non-qualified deferred comp is your accrued bonus, your accrued commissions, your salary and bonus deferral plans, your loan officer and branch manager compensation, stock, your stock options, restricted stock, STARS, phantom stock, your cash bonus plans, and any compensation you can really think of. So if the employee has a right to receive income which is not subject to substantial risk of forfeiture or other substantial restrictions, the employee is taxed on income on the date that right first arises. Keep in mind that wage withholding is due when rights arise when cash is not paid. This makes it extremely difficult for payroll to track, and an employee cannot defer taxation by delaying cash receipt. The employer's deduction in the employee's taxable income match up in the same year that constructive receipt occurs. If the constructive receipt is closed, the employer will never be able to take the deduction. So under 409 Cap A, there are 4 technical requirements that we'll cover. So the first one is the initial deferral election. So in general, employee must make the initial election to defer compensation before the year in which the services are performed. In an employee's first year of eligibility, it may make a deferral election the first 30 days of participation, but the election may only apply to compensation earned after the election was made. So the second rule is the timing of payments. Payments under non-qualified deferred plan must be made at the fixed date under a fixed schedule or upon any of the 5 events: the separation from service, death, disability, change in ownership or control of the corporation, or unforeseeable emergency. If the timing of the payment is based on a specific event, the plan must designate an objectivity determining the date of the or year after the event in which the payment is made. The rule prohibits haircut provisions under which a participant may take payments at any time, subject to a reduction in the amount. The third requirement is the anti-acceleration rule. Payments of deferred compensation generally may not be accelerated. IRS has provided exceptions to this rule, such as payments necessary to comply with domestic relation orders, payments necessary to comply with conflict of interest rules, and for certain payments when plans are terminated. And the fourth technical requirement is the ladder deferral election. If a non-qualified deferred comp plan permits the employee to elect or to delay or change the form of payment, the following conditions must be met. The election may not take effect until 12 months after the date in which it's made. If the election relates to a payment that isn't on account of death, disability, or unforeseeable emergency, the first payment for which the election made must be deferred after at least 5 years. An election related to a payment at a specific time or under a fixed schedule may not be made less than 12 months before the date of the first schedule. This must be in a written plan document, and it must operate in accordance with that plan. The 409A exception is when compensation is paid within the 2.5-month rule, which you typically see with accrued commissions and accrued bonuses. So unless the deferred compensation is paid pursuant to the short-term deferral, which is the 2.5 months, it cannot be paid prior to the earlier of the following dates, which we had covered, which is the separation of services, the date the service provider became disabled, the service provider's death, a specific time or fixed schedule under the plan, a change in ownership, or the occurrence of an unforeseeable emergency. So I was just going to go through an example. If an employee's bonus earned at December 31st, 2011 that must be paid prior to December 31st, 2012 satisfies the fixed payment date requirement. If there is no requirement to pay the bonus by the specific time or on a fixed schedule, that payment must be made within 2.5 months short-term rule, or it will fail to satisfy the 409A requirements, subject being the employee to immediate taxation and penalties. Therefore, design of the bonus plan must either ensure payments will be made within 2.5 months or specify a time or event fixed schedule for the payments up front. Another example is a bonus plan that provides no set date for payments. If bonuses are paid on April 1st of 2012, the plan does not have a fixed payment date. The amount of the bonus that is earned on December 31st, 2012 and not paid until April 2012 are taxable to the employee in 2011 and subject to the 20% penalty plus interest. The employer then is required to report the bonus on the 2011 W-2. So keep that in mind if the bonuses are not being paid within the 2.5 months. A person's right to compensation is subject to substantial risk of forfeiture if the person's right to compensation is conditioned on the future performance of substantial services by an individual. A condition related to the performance of the compensation must relate to the performance of the service provider for the service recipient or the service recipient's business activities or organization goals. For example, the attainment of a prescribed level of earning or equity value or initial public offering. Things you should be thinking about. Do you have any deferred compensation that is not always paid out within the first 2.5 months after year-end? If so, is your plan a written one? Does your plan comply with 409 Cap A? Do you operate your plan in accordance with a written plan? Do you have a written plan to address all deferred compensation not paid within 2.5 months of the short-term deferral exception? Does your written plan, if any, comply with 409 Cap A? If you answered no to any of these, we recommend you seek legal counsel or give us a call and we can see what the implications are. As mentioned before, the tax consequences of a failure of a 409 Cap A are typical because the 409A rules are complex and compliance errors are likely to occur. The consequences of those errors are severe. All amounts deferred under a non-compliant, non-qualified deferred comp plan are included in the employee's income. Interest is imposed on that income at the rate of 1% point higher than the interest rate on tax underpayments. On the top of that, a 20% penalty is imposed. So you do have to report it on the W-2. There are codes to identify that that employee is subject to the 20% penalty. Recognizing this, the IRS has provided procedures that allow taxpayers to avoid the full impact of income exclusion and additional taxes. However, the scope of these relief programs is limited. First, it only applies to failures in operations of the non-qualified deferred comp plan, not to problems with the plan document. Second, the failure must have been inadvertent and unintentional. And third, the failure must be corrected within a limited period. In addition, employers must take reasonable steps to prevent the operation failure from reoccurring. If a failure occurs more than once, relief will be denied unless the employer has put in place practices and procedures designed to avoid a reoccurrence and has made diligent effort to prevent the failure. So that's all I was going to cover today. So if you have any questions, you can contact me. I provided my email as well as my phone. If you want to ask questions, you can now. Just a minute. We're seeing if there are any questions. Sorry, we're having technical difficulties right now with viewing the questions.
If anyone has any questions, just feel free to email us. We apologize for the technical difficulties with the GoToMeeting, but feel free to shoot us an email or give us a call, and we'd be happy to go over any questions or anything you have for us.
We'll answer the questions that's already been asked in the email, and then feel free to contact us directly if you have further questions. And we will also be sending the slides out. So I think that's it. Thanks for attending the seminar, and if you have any questions, let us know.